Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. With me, my special guest and good friend, Dr. Friday with Dr. Friday's Tax and Financial Services. All right, we were talking before the break about things such as, well, let me just jump into this one.
Jump in, both feet.
Required minimum distributions. This is a big one.
Huge.
We were talking about how to avoid early penalties. So if you take money out before 59.5, as we were talking about, or 55 if it's for a 401k, then it's subject to a 10% tax penalty. So not only is it 100% taxable at ordinary income tax rates, in other words, you're not going to get any breaks as you would with capital gains and that type of thing. It's going to be at the highest income tax rate. Not only do you have that, okay, that's something we want to avoid. So now you're paying taxes, you got a 10% penalty. Guess what happens if you're past 70.5? All right? Once you pass 70.5, you have basically until April 1st of the following year to take your required minimum distribution. Now you got to watch it. Special rules here. If you take it out in the year in which you turn 70.5, that's fine. If you don't take it out, there is a, what's the penalty?
50%.
Ouch, right?
50.
50% penalty on not taking your required minimum distributions.
And now, not on the tax, on how much you didn't take out. So if you have a $10,000 RMD, it would be a $5,000 penalty, even if you didn't owe any taxes on it. Just throwing that out there.
There you go. That's this is one of the reasons that we talk this time of year. It has to come out. So if you turn 70.5 this year, or 70, well, let's say so this year, you have until December 31st of this year if you want it to count for this year. Now there are some exceptions again.
Right.
We technically have until April 1st of 2017 for someone that turns 70.5 this year to take the RMD. However, keep in mind if you do that, that's right, you'll have to take 2 required minimum distributions next year. One for this year, for 2016, and then one again for 2017. Sometimes that can be a good thing. We've done that where I've been able to have a person get another zero, squeeze in one more zero tax year before we and the tax bracket is still at the 15% whether they took it this year or next year, so there's no harm. And by waiting, we're able to save that, get one more, squeeze in one more year. But that's something you'll want to know. And here's another thing when it comes to required minimum distributions. All right, besides that rule of 70.5, you have to start taking that required minimum distribution. You're responsible. The financial institution, the custodian that has your IRA, a lot of times they will send you out notices, but it doesn't always happen. And guess who's still stuck with the penalty if they don't? It's not their problem. You can't go after them for not telling you you're supposed to do what you're supposed to do. Now, here's something else to keep in mind. Inherited IRAs. This is an important one because an inherited IRA, when someone passes away, in the year in which they pass, that required minimum distribution would go on their tax return, that final return for them. However, in the year after the year in which you inherit, so in the year after the year in which the person passed, the year after is when you, if you inherit an IRA, are now subject to required minimum distributions. And guess what? It doesn't matter what your age is.
Right.
Okay, this is one of those areas that
we've seen a lot of mistakes on that one.
There you go. All right, and that's what, you can. This is one of those that's quite common because people don't realize it. And if you're not, and I can't tell. This is one of those that custodians are even. They're very lax on that one.
Right.
Okay, they're pretty decent a lot of times about sending out the notices. Occasionally you miss, but on the other, it's the other way around. Occasionally they actually.
I can give you a little bit of a tax trip if it is your required minimum distribution and you are going to take it out. Think about giving it to charity. So let's say that you always give a couple $1,000s. Normally every week you give to tithing or whatever. Instead of taking it out of your pocket, and then most likely many people in their 70s are not itemizing because the standard deduction is quite high, and they don't have mortgages and things. Now, if you take it right out of the RMD, your required minimum distribution portion of your distribution, and you send it directly to the charity, now you're going to pay, guess what? Zero tax, and you don't have to itemize, which is where most of us lose out on that. So just think about not taking it out of your pocket every week, maybe sending them one big check once a year, or if you're getting your required minimum distributions, you don't have to take them most of my clients take them annually, but you don't have to. But however you're taking it, take a portion of it and send it directly from the custodian to the church or to whatever nonprofit you want to send it to, then you're going to save, save money, and you don't have to worry about itemizing and saving, because tithing and most seniors don't go together.
Right.
So there's a little trick.
And we'll take that a step further.
Okay.
I know this is a favorite strategy. This is one of your favorite strategies. In fact, is this every other year thing?
Oh, it is. So in some cases, we do have some people that still have small mortgages, but maybe property taxes. If you're in Williamson County or even Davidson County, your property taxes can be $3,000 or $4,000 every year. So consider paying them twice. So you pay in January, maybe, and again in December, and then you skip the next year. In that same year, you pay twice your tithing, right? So again, you get $4,000 or $5,000 a year in tithing. Instead of doing it every year, do it twice in 1 year. So let's say every other year you pay your property taxes twice and you put your tithing twice. The next year you take the standard deduction, which could be what, $14,000 for a married couple, especially over the age of 65 or thereabouts. And then the next year you maybe take $20,000, which then you itemize. So it's a great way of basically maximizing the deductions that you have within your power.
So this is a way that you can itemize. So first off, the first tip again, if you have money that is in an IRA, that you're going to have a required minimum distribution. Now, your required minimum distribution may be much greater than the amount you want to give. That's okay. You can take the amount that you want. You don't have to give the whole RMD.
No.
You can say, okay, well, I want to give $2,000 or $4,000 or whatever it is. Have that custodian. It has to go now. This is important. It has to go directly from the custodian, the IRA, to the charity.
And it can be multiple charities.
To you, you've just lost this benefit. You're going to have it then be subject to your that floor that you're going to have to meet to exceed the standard deduction to itemize.
Right.
Now the other part is, Dr. Fry was just saying on itemizing. Now this goes to where, let's say you don't, maybe this IRA part isn't part of the planning, but you can still itemize by doubling up on the things that would allow you to itemize 1 year, even though if you did it, just pay them every year, you wouldn't.
Right.
So at least 1 year you get to itemize, 1 year you take the standard deduction.
Right.
All of these are little ways that it keeps more money in your pocket, and this is understanding the rules and using them to your best effect.
I want to give it to me, not the IRS.
Absolutely. And inherited IRAs, this is another one of those that are really tricky. If you inherited IRA and you're in your 30s, 40s, 50s, whatever it is, even though normally on an IRA you don't have to take that required minimum distribution until 70 and a half, when you inherit, again, the year after the year, the year after the year in which you inherited is when you have to take that required minimum distribution starting then and going forward.
Right.
Now that's the minimum amount you have to take out. You can take more and still not have a penalty, then there's no tax penalty on those on the amounts you take out of an inherited IRA, but it is subject to still ordinary income taxes. Another thing is Roth IRAs. This is a tricky one. So Roth IRAs, if it's your Roth IRA and you reach age 70 and a half, guess what? You do not have to take a required minimum distribution from a Roth IRA. But here's something a lot of people don't know, and that's that on an inherited Roth IRA, you do. So if you inherit a Roth IRA, even though that's tax-free money now, so when you take that required minimum distribution at whatever, again, it's the year after the year in which you inherit, you have to take a required minimum distribution, but it's not taxable. All right, but it's still required that you take that money out.
Why do they make you take money out of an account that is not taxable anyways? What bloody purpose is that?
So that you don't let it grow tax-free forever. But they want to minimize, they want that account spent down.
And you can't roll it into your own Roth IRA.
Cannot combine them. Inherited IRAs and inherited Roth IRAs have to be kept separate from your Roth, your traditional Roth and
see, someone got smart there. Okay, that makes sense.
So the IRS rules are, if you inherit a Roth IRA, the year after the year in which you inherit, you have to start taking required minimum distributions. Single lifetime table is used for that. It's a little more aggressive than the uniform table.
I wonder what the penalty is if you don't.
Same penalty.
It is the same
penalty. On an RMD, yeah, it'd be that same 50% penalty. So now imagine that, giving up tax and paying a penalty on something you would never have to pay tax on at all.
That's crazy.
It is crazy, and that's our IRS, so we know that's congruent with what who we're dealing with here.
Yes.
So RMD again on inherited Roth, you make sure you take it. It does continue. That inherited Roth will continue to grow on a tax-free basis. It will also, on the distributions you take, will be tax-free. Just make sure that you take them, okay? All right, we're going to take another caller. This is Lynn. Lynn, welcome to the Retirement Report.
Hi. I wanted to ask you, I wanted to make sure I heard something correctly.
Sure.
Did I hear that you suggested, we fall into this category, that you pay double your property taxes? So you would pay this year and next year, and then double up on your contribution, your charitable contributions. Then that would allow you, hopefully, to itemize.
Right.
And then the next year you take the standard deduction.
Right. You wouldn't pay any property taxes. You wouldn't give any tithing because you paid them all. A lot of my people will do it like in January and then again in December, the December being for the next year. But yes, and that way you might actually get close enough, and every dollar you make above the itemizing is going to be more money in your pocket. Right now, if you do it every year, you never will make there. You'll never be able to get to it.
So this is a perfect time of year for that.
Yes.
Right?
Perfect time for planning for that. If your goal was you paid everything in 16 like you always do, and maybe we're going to do even years with you, you could pay your property taxes. If you have the cash flow, pay the property taxes for December, which are usually due in February, and go ahead and pay your standard tithing in December that you would normally pay throughout the year of 2017. Then you might, and it'd be something you want to talk to your tax person. I don't know how close you normally are, but then you might be able to take your do itemizing on your 2016 tax return. 17 will be the standard deduction. Remember, we do taxes on the cash basis for taxpayers. So whenever the money leaves your bank is when you get to deduct it.
Okay, so the tax is just out. It's due in February, and that's for, I think, 2016.
Right.
So is it too late? So what? This is where I'm a little bit confused.
Yeah, that's all right. Assuming you paid February of 2016 for the 2015 year, because most of us wait to the last minute to pay our property taxes. So if you paid in February of this year the taxes that were due normally, and then you go ahead and pay in December for the ones that are due on February of 17.
Oh, we're doing double.
Then you've doubled up, exactly.
Okay. Okay. Thank you very much.
No worries. Thanks.
You're welcome. Okay, one of the things that we get into with when it comes to tax planning, this is where, again, understanding how these rules work and working a lot of times in a team situation.
Definitely.
So Roth conversions is another one of those. This is an area where you cannot contribute to a Roth, after a certain age, okay? There are some exceptions, by the way, and this is understanding, again, how those work. For people that are still working past 70 and a half, for instance, you can't contribute to a traditional IRA. Now, if you're working still, and the employer you're working for has a 401k, you can continue to put money into the 401k and thus reduce down your taxable income even past the age of 70 and a half. Now, if you have, and this could be a little odd in that you may have IRAs that you're having to take required minimum distributions from, and money that you're putting into the 401k, but that could also be a nice way to offset those RMDs coming in while you've got earned income that's causing you maybe to pay higher taxes.
Also taking Social Security,
we take bigger amounts into the 401k. It's almost like we're able to offset that, right? That RMD, and help keep those taxes lower. And yeah, you might be getting Social Security at the same time, so that's another impact. Another thing when it comes to as long as you have earned income. Now, past 70 and a half, again, you cannot contribute to a traditional IRA, but you can contribute to a Roth IRA. Right. So this can be a way that you can still build up that nest egg, and in this situation, tax-free dollars. Now, a lot of this comes into play, and now on the contribution side, those are things that have to be done, or that you can do right up until you file your taxes April 15th. Right. However, Roth conversions, which is what we're going to talk about after we come back from the break, those have to be done before the end of the year. Yes. Okay, which is why we talk about that. So we're going to get into Roth conversions and how that's another way that you can minimize your taxes, because we're not just talking this year we want to minimize taxes, but we also want to look down the road. Minimizing today, if it doubles them next, 5 years from now, that's maybe not so good. So if there's a way that we minimize them today and minimize them in the future, that's the best plan of all. So join us here. We're going to talk about that and more when we return here on the Retirement Report.